Hi everyone, this is the 15th of October 2019. We've had a good day today as far as the Nifty is concerned, but we really didn't get a lot of follow-up from either the Bank Nifty or the broad market, that is the mid-cap indices. The breadth remained a little more positive than it was yesterday, but unless we get that broad-based movement, I think people will not be convinced of what is really going on in the market, because what I've been getting across social media is everybody reminding me that this move is a bounce and we're headed back to the 10,000 mark. Now that's a view that looked very likely, I think, a couple of months back when we were selling off post the election, but there are several reasons why I've started to think that's not the case. Now I've discussed them over the last couple of episodes, but what was really interesting, and because so many people are really coming out and they're doing so just around when I think bad news is probably in large numbers, because you've had not just the banking related news that kept coming out all of last week, but you had GDP downgrades over the last couple of days. One from, apart from the RBI, it got followed up by the rating agencies, and as and when this news is coming out, people start feeling, things are really not moving. But then things are not moving today. When the markets and stocks were up there, which is almost a year ago, when you had many of these financial stocks which have actually been hammered, and especially those which are high in debt or those were troubled for one reason or the other, they've now fallen more than 90 or 99%. In some cases, they're still probably falling in the last couple of days. And if something's gone from, say, a price of 1500 to 15, if that's the kind of downside you've already had, then it's probably already priced in, because somewhere around the 400 500 mark, when I was still seeing downside, I thought there was risk to the markets. And if that decline has already happened and that risk to the markets has not come up, then I think it's time to start thinking otherwise. So I think that's the thought process that I'm not seeing. I'm just seeing people increasingly looking at the negatives that have already come in, but overlooking what is really going on. And what was really important, and I've published, I think, So I want to just jump in and reflect a little on the growth data that we've actually seen. Of course, they're talking about higher growth next year, even though they've downgraded current year's growth to 6.1%. But I'm referring to a separate note here, which they're talking about the fiscal side and why India should be fiscally prudent. Now, this is something that you'll have heard over and over again over the last, I think, more than maybe 3 decades almost, that India has been told you should be fiscally prudent. Now, the fact is that we have been very prudent. We've been prudent for 2 decades. We've brought down our debt to GDP ratio at the government level from 90% to 62%, and that's a big feat. The whole idea of being fiscally prudent is to be able to use that space in a time when you need it, when things, when the chips are down. And if this is not a period where chips are down, then what is? So I really don't understand this argument and why it repeats when it makes completely no sense as far as the current situation is concerned. It is right to be prudent all these years, but what's the point of that prudence if you can't really utilize it right now? And mind you, this is what the whole world is talking about. Every country is looking at means of expanding their indulgence in the not just using monetary policy but fiscal policy, or what is being also called MMT, different means of intervening into markets to get growth going. And if that is the case, then what is wrong with what India has really done compared to what the rest of the world is anyway planning to do? Then why not go and point fingers at every developed country that is planning to do something similar? My long short report discusses a lot of this in detail. In fact, the most macro factors, and I spent time linking together how the key drivers in macro touch upon every asset class, and why things will move in a particular way that I think, and unless we are really wrong about that, we should probably see things work out in the way that I'm thinking. And I think last couple of days we actually saw a breakdown in the dollar over Thursday and Friday. Now, many people would think it was related to the China talks. That has been one of the biggest negative news that I think was floating around, and people were wondering whether this deal will go through or not. The expectation was, of course, high that they'll sign up something over the weekend, and they've agreed to some terms, but they're really not signed up on anything. So But you would think that the sell-off in the dollar that we saw was probably related to the trade wars. But when I look back at it, there was also something else that happened, and I think it happened on Thursday. There was a video of the Fed chair, which was moving around the web, and if you actually had a look at it, he announced, and it was it was not wide in the news, but I think everybody's noticed it, that he clearly mentioned that they are moving back towards an expansion of the balance sheet, which is something we knew was coming, because from last year when they stepped back on from rate hikes to rate cuts, they also said they are ending quantitative tightening. Question was, when are they going to get easing? Some people thought it'll be after a market crash or after the economy goes into recession. You've had some sell-offs in the market, but you haven't had that 20% cut, and you're already into an earnings season which is likely to be the worst or last of the very bad ones for the US equities, with some kind of a negative 4% earnings growth, and then after that things will probably stabilize a bit. So if things had to get bad or have to get bad, it's now. But then the Fed is front stepping it and saying we are going back into an expansionary mode, expanding our balance sheet, but we won't call it QE, and it's probably meant to help liquidity conditions, or probably I would think it's the demand from Treasury, because they've expanded their deficits that really need to be funded. So there's this demand for money that has to get funded, where the Fed will really be stepping in it. So it's no more for the reasons that they were doing it earlier. They were expanding balance sheet earlier to deal with the Great Recession, but now they are doing it to finance the Treasury. So I think that's the change. But the change is also that around the world, every central bank is now moving towards an easing condition or some kind of stimulus. We are definitely stimulating with our tax cuts, and when we are doing that, then what kind of impact is it going to have on equities and other asset classes? So I think that's the depth of the discussion in my long short report. So if you haven't seen it, you should probably go and read it there if you want to read about how we link it all together, and then come to what our markets are likely to do in the months or weeks ahead, and why I'm having a differentiated stance. So at least stepping back till more evidence shows up. Otherwise, definitely the markets have weakened after all the even the positive news, but I think the negative news is settling in. You still got to see that pop in the banking sector, which is what will give probably more confidence to the market that we are getting some momentum. The other thing is, last time I mentioned this, and I'll mention it again, the housekeeping event. Starting from December, mid-December, we'll be doing a mentorship program. So anybody who's interested, you can see the number down on the screen. You can simply call Chavan and speak to him about it. It'll be a 3-month rigorous, in-depth mentorship across Elliott Wave to how you apply it with market models and trading screens and so on, what kind of filters and trade setups that I actually use. So I think if you like to go through that kind of a session, very detailed, over 3 months, then you get in touch with him and go over it. So moving on, I think we've gone through the India Bulls housing finance case. We've had their merger got rejected. You have the Fed coming back and saying we are going to expand the balance sheet. We've already had RBI do that. You had Trump and China agree that yes, they will sign up something, not right away, but they're going to continue to have talks, but probably by sometime in November, I think they would be expected to finally agree to something which is before the year end, so that they can actually pull back on some of the taxes that they have, or duties that they have actually imposed on each other. The new ones are of course not going through, which was supposed to happen from today, but I think once they do sign up something, they'll probably even remove some of the existing duties, because and the way I look at this whole affair from a very different angle is that I think it's all directed towards price increases, though it's really not helping growth in particular sectors, especially say agro trade between US and China. But now if they agree to larger imports of agricultural goods, it actually puts upward price pressures for agricultural goods, and at the same time all the import duties that US has imposed has also put upward price pressure. And so I sometimes wonder whether this is just part of the inflation targeting regime with completely different political language, but the same thing the Fed was trying to do and it was not able to do it, or various central banks not able to get inflation, and here you have the US directly imposing duties and raising prices, because it's a tax in a different way that you're really putting on prices that you're buying from someone else. So that's how you actually look at something without the smoke screens in front of it. but that's what has happened in the meantime. So the most direct impact of all this is that every currency starts to weaken, but really the one that will weaken the most will be the elephant in the room. And so that's the important part of the discussion as to how the currency markets are really going to behave, because there's a lot of liquidity that's going to be floating around and going to be searching for avenues to get invested into. Now lastly, I will end with this chart, which I said on Twitter yesterday I would discuss, and it was also part of the article that went out on Business Line. It's a repeat of what I spoke about and discussed in September as well. The only difference is that in September you had the highest extreme of FII short positions. So when you look at this chart of FII client data, and this is just over a 1 year time horizon data, because this is what I thought was relevant to the current price range. Otherwise you had a wider range with this data, especially on the long side. Short side, this was the highest. So this time's reading in September was at minus, I think, 124,000 contracts odd. We'd never seen them this short, and from there you got some kind of short covering, but it was event driven, which is why some people would think it's less relevant. That said, they continue to be short on both the futures and option side. This chart of course shows only the futures, and you can see they're still at 54,000 to 40,000, I think, yesterday night contracts as per yesterday's closing. I haven't seen today's data, will come later tonight. We are still on this chart way lower than where you were at previous tops. That's the main point. So really not there to say that okay, you've gone in excess, everybody's turned bullish or the trades have reversed from short to long, as has happened every previous time when you see the data plotted. That's not happened, and which is why I think that there's still more room for them to cover. There are two ways they could do that. One is through actual price action, which is through actual buying, which you would see in daily index futures, or they give up their position on expiration. That's something they've done a couple of times before, but they don't always do it. So we haven't seen it happen very regularly. I think in 2012-13 I saw it at least twice, and when they do that, then of course you get a gap up in the markets. But last two times, both in August and September, at the end of the month, there were meaningful shorts and they didn't cover, which is interesting. And so they continued to carry it. And so I don't really know whether they do that at the end of October. But till that point of time, we have still 3 weeks to go, and they're still short in both the futures and option segments. And that's the main point that I was driving across, which is where you can still get short covering from foreign institutional investors. So that's all in this update. Thank you.